Ever thrown down money for something digital? Like, maybe a cool skin in your favorite game and thought, wait, how does this virtual thing even have value?
Right.
Well, today we're diving deep into that wild world of NFTs, trying to understand just that.
Yeah.
And we've got this awesome research paper as our guide.
Yes.
Market microstructure of non-fungible tokens. Catchy, right?
Definitely.
But it's going to help us explore how those prices go from, well, $0 to $1 million sometimes for like a cartoon ape.
You're not wrong to see the irony there. It's a whole new world of market mechanics.
Yeah.
Frankly, traditional economics doesn't quite have the playbook for this one.
So true. Okay, so let's start basic. How are NFT prices even set? Is there like an NFT stock exchange we don't know about?
Not quite a stock exchange, no. This paper, it lays out two main avenues: fixed pricing and timed auctions. So fixed pricing, that's the simple one, relatively. The seller sets a price, like a digital price tag, but buyers, they can still try to haggle with offers.
Oh, interesting.
Yeah, the twist is the seller, they don't have to play ball. Makes it a more, a more nuanced dance than your average online sale.
Okay, so imagine like a digital flea market where you can lowball a cat meme NFT.
Exactly. Then we've got the timed auctions, and the paper really focuses on English and Dutch auctions, which are commonly seen on platforms like OpenSea, which I'm sure many of our listeners are familiar with. English auctions are your classic bidding wars. The price goes up until nobody wants to bid higher. But for NFTs, there's a clever twist. Any bid close to the deadline, what it does is it extends the auction, just ramps up the tension even more.
Oh, wow. Talk about a digital adrenaline rush. Okay, what about these Dutch auctions? They sound mysterious.
Yeah, imagine like a countdown sale where the price, it drops until so many else sold. It starts high and steadily decreases over a set time, and the first person to jump on it gets that NFT at that price. It's a gamble. Do you snag it early for a higher price or risk someone else grabbing it while you wait for a better deal?
So NFTs really know how to play on that fear of missing out, huh?
Oh, absolutely.
But this paper, it mentions that NFTs are more like assets than securities, and I'm curious, why does that even matter to us regular folks?
Right, it's a crucial distinction. Securities, like company stocks, they represent ownership, and they're fungible. One shares the same as any other.
Yeah.
NFTs, on the other hand, they are one of a kind. They have this unique digital signature.
Right.
The paper actually points out that the maximum supply of an NFT is just one.
Oh, wow.
This scarcity, it's more like owning a rare comic book or a piece of real estate. It's not like a stock certificate.
Interesting. So those models economists use to like explain stock prices, they don't quite work in this NFT world.
Exactly. Traditional market makers, they rely on having, a bunch of an asset to stabilize prices.
Mm-hmm.
But how do you have an inventory of something that is totally unique?
Yeah.
You can't just print another CryptoPunk when you need one.
Right. That is so different. So then how in the world do we even try to determine what an NFT is really worth if these old systems, they don't apply?
Yeah, so the paper uses this phrase, hype-driven with legacy bias.
Correct.
Basically, an NFT's worth is heavily influenced by trends, celebrity endorsements, the creator's reputation. Think of it like, a social media frenzy. The more buzz, the more people want in, even if it's just to be part of the next big thing.
Mm-hmm.
The legacy bias part, what that means is those early NFT successes, like your CryptoPunks, they still influence how people value newer projects.
It's like that cool kid in school that everyone wanted to be friends with just because they were the cool kid.
Exactly.
And of course, we can't forget gas fees, which, they're not your average transaction cost, right?
Oh, absolutely not. Unlike your typical brokerage commissions, gas fees are payments for the energy it takes to process your NFT transaction on the blockchain. And these things, they can swing wildly based on how congested the network is.
Oh, wow.
Making it even harder to predict the real cost of buying or selling an NFT. Imagine if you're trying to buy that rare Pokemon card, but the shipping cost, it changes every minute.
Oh my gosh. So you're telling me I need to factor in the NFT's price plus this unpredictable gas fee just to even make the trade.
Welcome to the world of NFTs.
That's wild.
Now, while some platforms, they're trying to make gas fees less of a headache, it's still a major factor for anyone looking to buy or sell.
Right.
But to truly understand the NFT market, we need to zoom out, look at the bigger picture.
You mean like the entire NFT marketplace itself?
Exactly.
I bet this research paper, it probably breaks down all the different types of NFTs out there.
You bet it does. It categorizes NFTs in two ways. The project level, which is all about the type of NFT being offered, And then the ownership level, which distinguishes between that initial sale and then any resales down the line.
Okay.
So let's start with the project level.
Okay, hit me with it. What kind of NFT segments are we talking about here?
All right, so the research, it points to 6 main categories: art, collectibles, sports, utility, metaverse, and games. And when they looked at the trading volume, art and collectibles, they were the big players, especially back in 2021.
Yeah.
No surprise there.
Not surprising at all. It seems like every day there's a new digital art piece making headlines.
Yes.
But what about those other segments, like utility NFTs? They sound a little more, well, useful.
Exactly. Think of utility NFTs as like digital keys that unlock exclusive perks. Imagine access to special online communities, voting rights at DAOs, or even real-world goodies tied to your NFT. It's less about owning like a digital picture and more about what that picture can get you.
So it's like the difference between having a backstage pass versus just a regular concert ticket.
Exactly. Now, when we move to the ownership level, things get even more interesting. So the paper breaks it down into primary and secondary markets. The primary market is where NFTs are born directly from the artist or the creators.
Okay.
This is where you find those coveted mint prices everyone's after. But the real action, where prices can skyrocket or plummet, that happens on the secondary market. This is where NFT owners resell to other collectors, and that's when you see the real market dynamics at play.
It's like the art world, you know, like
Yeah.
with galleries representing artists initially and then collectors reselling among themselves later on.
Spot on. And just like with physical art, the secondary market's health, it reveals a lot about an NFT project's future. Lots of buying and selling. That means there's real interest, there's real demand, but a quiet secondary market could be a red flag, could signal low engagement, or even a potential rug pull.
Rug pull. Okay, that doesn't sound good.
It's not.
Yeah.
We'll dig into the shadier side of the market a little bit later. But essentially, it's a scam where creators hype up a project, attract investors, then vanish with the money, leaving everyone with worthless NFTs.
Yeah, noted. Always be on the lookout for those red flags. Now, this paper, it mentions USDS and USDD, and I'm not going to lie, it feels a bit like alphabet soup to me. What's the deal with those?
Right, so when we're talking about the NFT market's maturity, this paper says it's crucial to understand the difference between USD from sales, your USDS, and then USD from dApps, which is your USDD.
Okay.
USDS, that one's a bit more straightforward. It's the total value of NFTs traded, both those first sales from creators and then any resales afterwards.
Okay.
Basically, the total cash flow in the NFT ecosystem.
So it's like a measure of the market's pulse, how much money is actually flowing through it. What about USDD? That one sounds a bit more complex.
It is. USDD is about how much NFTs are being used, not just bought and sold. So it represents the trade volume generated by like interacting with the NFT through its smart contract.
Okay.
Think about, upgrading your NFT, combining it with others to create new ones, like in some blockchain games, for example, or even using its collateral in decentralized finance.
Okay, so if I'm getting this right, a healthy amount of USDD means that people are actually using their NFTs, not just letting them kind of collect digital dust.
Exactly. And the paper makes a really interesting point. As USDD grows and that gap between it and USDS widens, it suggests the NFT world, it's maturing. It's shifting from hype and speculation to a more sustainable ecosystem, one where NFTs have real applications. They have real utility.
It's like NFTs are graduating from digital collectibles to becoming tools in the digital world.
Yes.
That's fascinating.
It is fascinating. But before we get too caught up in the possibilities, let's not forget about the other side of this rapid growth and innovation.
You mean the part where we talk about scams, market manipulation, and how to actually protect ourselves in this digital Wild West?
You got it. Because, like any new frontier, the NFT space, it attracts its fair share of bad actors.
Right.
But don't worry. We're going to equip you with the knowledge and tools to navigate it safely, make those smart choices.
I am ready to gear up. All right, listeners, we're back and ready to kind of tackle that shadier side of the NFT market because let's be real, where there's money to be made, there's usually someone trying to game the system.
Absolutely.
Yeah.
That's why it's so crucial to, arm ourselves with information. And this paper, it does a really good job of pulling back the curtain on, some of the manipulation that can happen.
Yeah, no more sugarcoating. Let's talk transparency, or should I say the lack thereof.
Yeah.
How can we even be sure that what we're seeing in the NFT market is even the real deal?
You've hit a major pain point. In a decentralized world where anyone can create an anonymous wallet, it can be really tough to know, like, who's buying, who's selling, if those $1 million transactions are even legit.
Right.
And that's where our friend wash trading comes into play.
Wash trading. Okay, that sounds like something you would do with like a dirty NFT, not in the market.
Well, it's definitely a way to make something look a lot cleaner than it is. The paper defines it as creating this fake market activity by trading an NFT back and forth between accounts controlled by the same person or group.
Oh, sneaky.
Yeah, so they're essentially pumping up the volume, often the price, to create this illusion of like desirability and demand.
So it's like creating like a fake buzz around an NFT, like those lines they used to have outside, like nightclubs, to make them seem way more exclusive than they really were.
A perfect analogy. And what's so interesting is this paper doesn't just like define wash trading. It actually breaks down some of those sneaky tactics that are used. They call them wash trading motifs, which are basically like these patterns and behaviors on the blockchain that scream, hey, something fishy is going on here.
Okay, I'm all ears. Spill the digital tea on these shady tactics.
Some of them are surprisingly simple, like someone rapidly selling an NFT back and forth between their own wallets, each time bumping up the price a bit.
Yeah.
This creates a public record of rising value, even though no real profit is actually being made.
Wow.
But then it gets even more complex with, multiple wallets, interconnected transactions, even exploiting how some marketplaces, they rank projects based on trading volume. It's like it's a digital shell game that's designed to trick those unsuspecting buyers.
Wow, it's like those rigged carnival games, but like for digital collectibles. So people engage in wash trading to drive up the prices of their own NFTs. And then what? They just hope some like unsuspecting newbie buys into the hype.
You got it. They artificially inflate the price, create that buying frenzy, and then cash out before everyone realizes what's really going on. A classic pump and dump scheme, just dressed up in, digital clothes.
Not cool, not cool. So how do we stop these NFT bandits? Is there like an internet police force that can like shut these operations down?
It would be great if it were that simple. But the decentralized nature of blockchain, which is, one of its strengths, makes regulation incredibly challenging. There's no central authority to like swoop in and impose order or, track down these wash traders. Kind of like the Wild West out there.
So it sounds like it's really up to us to protect ourselves. But how? Like, how can the average person who isn't like a blockchain expert avoid getting, duped by these tactics?
Knowledge is power, my friend.
Yeah.
Understanding how wash trading works and being able to spot those red flags we talked about, that's a great start. But even more important is just good old-fashioned due diligence.
Due diligence, huh? So like doing your homework before you buy into an NFT.
Precisely. And this research paper, it actually provides this really handy checklist for anyone looking to buy NFTs.
Yeah.
Think of it as your like NFT safety manual.
Okay, I'm taking notes. What's the first rule in NFT Safety 101?
First and foremost, is the project legit? And I don't just mean like a fancy website or a bunch of, followers online. Look for independent audits of their smart contracts.
Oh.
Yeah, this helps ensure that the code behind the project is actually secure and their claims are credible.
So it's like getting a home inspection before you buy. It might not be glamorous, but it can save you a lot of trouble down the line.
Exactly. Next up. Who's behind the project? Are they anonymous, or are they putting their real names and reputations on the line?
Right.
A quick Google search can be incredibly revealing. It can give you insights into their experience, their track record, their overall credibility.
I'm sensing a theme here. Don't just trust the hype. Do your own digging.
You're catching on quickly.
Yeah.
And that brings us to the third question on our checklist. What makes this NFT valuable? Is it the art itself? Is the utility it offers? The community it provides access to? Really understanding that value proposition is key to determining if the current price is, justified or just fueled by hype.
It's about like separating the signal from the noise, right?
Yeah.
Figuring out if there's like real value there or just a bunch of empty hype.
Precisely. Now for question number 4. Is this project truly decentralized?
Okay.
This is a big one in the NFT space where the idea of like community ownership and governance is a major selling point.
Yeah.
But the reality can be quite different.
Yeah, for sure.
So look into their documentation. Find out who controls the majority of the tokens, how decisions are made, and if there are any kind of centralized points of control that could pose a risk.
It's about looking beyond just the buzzwords and understanding how the project actually operates.
Yeah.
I like it. What's the final question on our NFT safety checklist?
Last, but definitely not least, is there true scarcity? Remember, scarcity, it's a key driver of value in the NFT world. But don't just take the creator's word for it. Look at the total supply of NFTs in the collection. Fewer NFTs usually means greater scarcity and potentially higher value over time. But also, how are those NFTs distributed? Are they concentrated in the hands of a few big players? Or are they more evenly spread out amongst the community?
It's like the difference between owning a limited edition print versus a mass-produced poster, right?
Yeah.
One is inherently more valuable because of that scarcity.
Exactly. So by asking these 5 key questions and really truly digging into a project, you can significantly reduce your risk and make, more informed decisions.
Right.
Remember, knowledge is your best defense against those looking to kind of take advantage of the unwary.
This is gold. I feel like I just leveled up my NFT game. But even if a project checks all those boxes, there's still the legal side of things to consider, right? Because NFTs and the law, it seems about as clear as mud right now.
You're not wrong. It's a bit of a Wild West, legally speaking.
Yeah.
But that's what makes it so fascinating. And this research paper, it delves into some really interesting legal questions, especially surrounding the Howey test.
Oh, the Howey test. Okay, that sounds kind of intense.
So it's a bit of a legal mouthful, but essentially it's a test used to determine if an asset, in our case, an NFT, should be classified as a security.
Okay, back up for a second. Why does it even matter if an NFT is considered a security?
Because if it is, it triggers this whole avalanche of regulations and requirements that could drastically change how NFTs are, bought, sold, and traded. The paper does this deep dive into each part of this Howey test, applying it to the world of NFTs.
Wow, sounds like a complicated legal puzzle. So what's the verdict? Are NFTs considered securities or not?
The short answer is, it's complicated.
Ugh, figures.
Right. The regulators, they're still trying to figure it all out. But here's the gist. Generally speaking, NFTs, as they stand now, they're more like those collectibles or artworks we talked about than like traditional securities. But there are exceptions. If an NFT acts like stock, representing ownership in a company or promising a share of future profits, it might get slapped with that security label.
So it's a case-by-case basis. And when in doubt, tread carefully.
Exactly. And while we're on the topic of caution, let's not forget about intellectual property.
Yeah.
Just because something exists digitally doesn't mean copyright laws go out the window.
Right. Just because you buy an NFT of a cool artwork doesn't mean you now own the rights to it.
Yeah.
That still belongs to the artist, right?
Exactly. The paper gets into this kind of tricky relationship between NFTs and intellectual property, especially when it comes to copyright and trademarks. So buying an NFT of a digital artwork, it doesn't automatically give you the copyright to that artwork. The creator still owns those rights, unless they explicitly say otherwise.
So to be super clear, I might own the NFT, like a one-of-a-kind trading card, but the artist still holds the copyright, like the right to print more of that card.
Exactly. It's like, buying a limited edition print of a famous photograph. You own that print, but the photographer, they still hold the copyright to that original image.
That makes sense. Okay, so what about trademarks then? Could someone create an NFT using, say, the Nike swoosh logo and get away with it?
That's where things get really murky. The paper brings up trademark issues as this big gray area in the NFT space. There haven't been many clear-cut legal decisions yet. So it's best to, err on the side of caution.
Yeah, it feels like we need a whole other deep dive just to unpack all the legal complexities of NFTs.
Right.
But before we wrap up, there's one more elephant in the room.
Ooh, taxes.
Ah, yes. Those pesky taxes always seem to find their way into the equation. Unfortunately, the answer, as with many things in NFTs, is...
It depends.
It wouldn't be a true deep dive without a little, it depends, right?
Right. But here's the gist. If you're creating and selling NFTs, the money you make, that's considered income, just like any other job. But good news is you can usually deduct any expenses you had while, creating and selling those NFTs. So keep good records.
So it's like running a small business, you've got to track your income and expenses for the tax man.
Exactly. And if you're buying and selling NFTs for profit, any gains you make are, subject to capital gains tax. Basically, the longer you hold on to an NFT, the lower your tax bill might be.
So buy and hold isn't just an investing strategy. It could be a tax strategy, too. Who knew?
Right. And then there's the whole issue of sales tax on NFTs, which is a whole other can of worms. We probably don't have time to open today.
Okay, I think our brains are officially full for one episode. So as we resurface from this deep dive into the NFT market, what are the key takeaways you want our listeners to remember?
First and foremost, knowledge. That is your most valuable NFT.
I love it.
Do your research, ask questions, and don't be afraid to dig into the tech, the market trends, and yes, even the legal stuff.
Yeah.
And never ever believe those get-rich-quick promises.
Yeah, if it sounds too good to be true, it probably is.
Exactly. And if you're ever unsure about something, don't hesitate to, consult with a financial advisor or a legal professional who knows their way around the blockchain.
Solid advice. Well, listeners, we've journeyed through the exciting, unpredictable, and sometimes perplexing world of NFTs. We've explored how they're priced, how to spot those scams, the legal gray areas, and yes, even those pesky taxes. But this is really just the beginning. The NFT space is evolving at warp speed, so who knows what the future holds. But if we approach it with a healthy dose of curiosity, a little bit of skepticism, and a commitment to learning, we can ride this wave of innovation without, getting wiped out.
Couldn't have said it better myself.
A huge thank you to our expert for being our guide through this digital jungle. And to our amazing listeners, thanks for joining us on this deep dive into the world of NFTs. We'll have links to the research paper and other helpful resources in our show notes. Until next time, happy diving.